We are 15 minutes away from closing bells on Bay Street and Wall Street. Joining us now from the TSX is Diana Avigdor, head of trading at Barometer Capital. Diana, good to be with you today.
Thank you very much for having me.
Thank you. And why don't we first start with all the volatility that we've seen in these pot stocks this week. What did you see and what do you make of it?
It's still a small sector. It's still very much in the hands of individual investors trying to speculate. It's highly speculative is what I'm trying to say. They're extremely expensive still relative to revenues. However, I guess it is an emerging sector. It will be eventually an emerging sector. It will eventually grow. It is right in the midst and the crosshairs of all the new liberal regulation. Profit margins are high. There are all kinds of headlines, who's going to sell, who's not going to sell, how is it going to translate into revenue and so forth. It's still a highly speculative sector.
Is it
still very small cap?
It is small cap. Is it something, though, that institutions can even participate in, or are they participating in it?
Yeah, so this is the issue when, daily trading volume on some of these things some of these stocks are less than $50 million. If you're a large pension asset manager, U.S. asset manager, mutual fund company at $100 billion or more, it's not institutionally scalable from a volume perspective. And so what it becomes, it cannot be purchased to the extent that it can be purchased across all the funds in fair allocation model. And number two is, then you're subject to the volatility and the liquidity of the exit. So of course you can't put a lot of the portfolio in there, and so it becomes a bit of a chicken or the egg. And this is why I said it's still firmly in the hands, I think, of smaller traders, retail holders, and be careful. These things are volatile. What can go up 80% in 2 days can also come down 40% in 2 days. So be careful in your portfolio and take the appropriate risk parameter.
Diana, it's almost as though we're going to have friends who aren't in the industry talk to us about it at cocktail parties and dinner parties, almost like the internet days. Yeah. What would you say to somebody today?
Well, I would say that, it's highly speculative. Be careful how much of your portfolio you put in. Make sure that you're able to handle and financially the volatility. If you put 2% or 3% of your portfolio in one of these stocks for the next 20 years on the premise that regulation is going to be friendly, then sure. And at some point, we'll see how it plays out. Internet stocks way back when, where also some of them stayed and some of them disappeared. So there's going to be a process of selection over the next 10, 20 years, and you just have to kind of figure that out as you go along. But it's certainly thematically a sector that that's here to stay probably.
Let's talk about the broader market, Diana, in terms of the Trump victory and what that does to your investment thinking and investment process.
Yeah, so I think that the Trump so we had two scenarios, Clinton and Trump, and with Clinton, everybody expected market was going to continue its path up and maybe go up 2-3% on the election. And with Trump, the expectation was that it was going to go down 5 to 10%. We said that it was going to be down in a V fashion and that it was going to be a buying opportunity. Markets were very disciplined. I get that there was an event, but markets were not showing any kind of volatility or any kind of fear. Actually, yes, in the options market and the volatility markets and some of the currency markets, that's where you saw the election trade play out, but the breadth in the market and the stocks and the fundamentally sound stocks, so we're not showing major deterioration beyond normal 2-5% volatility. So I think that the election basically pushed ahead already a preconceived scenario. The market was already set up, and to that end, we were fully invested. We thought markets were looking okay. There was no reason to sell. The sectors that were working, we discussed this, was internet. Financials were already working. I mean, all of the metrics that Mr. Trump stands for, say growth, little inflation, and rates, rates is a key thing here because it affects the utilities, it affects financials, it affects economic growth and so forth. Rates. The question is not whether they're going up. The question is how much and how fast. And we don't know the answer, but what we do know is they're not going down. So, infrastructure, we discussed, you and I, that most governments out there are looking at all of this now because monetary policy has pretty much run its course. So it's just a kick ahead, a boost, let's say, to an existing scenario. And the worries are natural. Inflation, too much inflation, all that is ensuing. But we're in the beginning of the process.
I wonder as well, though, Diana, there were a number of very large, well-known hedge funds in the United States, famous investors, if you can call them famous, but they were very negative on the U.S. equity market. They essentially said that the valuations were too high to warrant, or that the valuations were too high, that the earnings did not warrant where the valuations are, and we're really quite concerned. And so, if anything, very bearish. The Trump victory potentially has changed the earnings outlook for a number of corporations because of the lower tax rates, deregulation, higher interest rates, trade agreements, you name it. Do you think, I wonder if some of these investors are going to change their outlook and you've got all that potential money flowing back into the market?
So there have been pretty vocal investors, and it's been interesting that nobody was invested in the market. This was a market that was skirting highs with very, very little love. Everybody hated it. Cash levels were high, leverage levels were low. Yet market was skirting highs. Expensive. So there's several things you touched on. Valuations, they're not really that high in the scheme of things. They're not low, but they're not, say, what they were in the tech bubble. And we know what averages are made of some very, very high number, very, very low number, and then something in between, and that makes an average. So, and then valuations only were never a trigger for a stock market sell-off. Usually valuations also reflect expectations, and sometimes the expectations of earnings and growth to ensue are priced into those valuations, and they're expected to go up. So you look at a stock and you say, okay, this is 2 points higher than it should be, but you know what? Growth here is understated, because if this happens, if regulation comes off, then the growth was going to increase. Look at the banks. So valuation on its own is not a reason to sell a market. There's a sort of, I don't want to say it, too strong. I mean, there's pluses and minuses, but there's always a reason why something is trading like it is. So are they going to change their minds? I mean, a couple of them I think already did. Are they going to be invested? I don't know. I can't speak for them. But what we have seen on trading desks in the last week and a half too, talking to different traders and looking at trades, and I'll explain that in a minute. Real money has actually entered the market here. Right. So
that's what I'm getting at.
Right.
Yeah.
So so when you're looking at indices like the S&P or any kind of sectoral sub-index, and you compare it to, say, short interest indices, so you can look at what's highly shorted and you make an index out of it and you sort of watch it, and you see that the fundamental indices have outperformed certain short indices, not in the materials. Materials was a lot of short covering. But some of the others, like the financials, they received a lot of real money. You could tell it's new money. So maybe that's, maybe to your point, maybe some of that money is trickling in now.
All right, we got to leave it there, Dana. Good to see you. Thank you.
Thank you. Thanks for
Have a
having
good
me.
weekend.